Assalamu alaikum everyone. Today it's our fourth lesson of our financial accounting lessons, and we're gonna talk about inventory. What is inventory? In the companies, inventories are the goods that they have. Uh, these may be work in progress goods, raw materials, finished goods. For example, in a store, its inventory may include different kinds of chocolate bars, meat, groceries, vegetables, and so on. And we have another term. This is cost of sales. What is cost of sales? It is the cost of the product that we sold. By finding cost of sales, we will find gross profit. Gross profit means how much of our revenue is excess of the cost of our goods. That's it. Our cost of sales includes the following expenses: material costs, carriage inwards, import duties, freight, production overhead, and direct costs. Actually, carriage inwards includes these three of them, right? Import duties, freight, and freight, and sometimes it may be shipping and other kinds of things. Or we may say like that: our cost of sales includes the expenses that we incur to bring our inventory into the working condition, and that's it. There are also some expenses that we exclude in our cost of sales: abnormal wastage, storage cost of finished goods, carriage outwards, administrative overheads. For example, what is abnormal wastage? In the production, we spilled our oil extra. This is abnormal wastage. Storage costs of finished goods. If we finish our production, our cost of our conversion, our goods will be finished, and its storage costs are not our cost of sales. Carriage outwards. This means selling expenses, distribution expense, or for example, expenses of the fuel for the any cars that is used in distribution. Administrative overheads. These are indirect labor or other expense, marketing expense, rental expense, and so on. How do we find our cost of sales? We have the revenue, and also we have the opening inventory, purchase, closing inventory, and cost of sales. In the financial accounting, you will use your opening inventory, purchase, and closing inventory to find your cost of sales. After that, we will find gross profit. Cost of sales equals opening inventory plus purchase less closing inventory. This gives us our cost of sales. After that, we deduct the cost of sales from revenue to find our gross profit or loss. Okay, there is also one theory that the higher the cost of closing inventory, the higher the profit, and you have to learn by heart, or that means they are direct proportional for each other, our profit and closing inventory, because closing inventory reduces our cost of sales, which means our closing inventory reduces our expenses to give more profit. Or another important thing is opening inventory is the closing inventory of our previous period, or closing inventory will be opening inventory for the next period, and that's it. For example, if we try to find any kind of gift, for example, we had the sales of 200 and opening inventory of 50, purchase was 150, and our also closing inventory was 30. That gives us cost of sales of 180. So our gross profit, that gives us cost of sales of 180. So we will find, how did we find our cost of sales? we added 50 and 150. After that we less closing inventory 30. That gives us 180, which gives us 20 gross profit. I think this is understandable. And okay, we have to find the cost of sales. Actually, how do we value our inventory? We will value our inventory at the lower of cost or selling price, or we may call it NRV, net selling price, net realizable value, right? How will we find NRV, net realizable value? We will compare our cost and selling price less cost of conversion. For example, actually our inventory costed us $15, and we are selling this inventory for 25 if we convert it into the finished product after incurring $5. This gives us $20. So in this case our NRV will be 15. Why? Because we are taking the lower of cost and also selling price. Selling price is fine here, selling price less cost of conversion. Okay, we have also different kinds of methods to value our inventory. First of all, it is FIFO, and before we have also unit cost method. Unit cost is multiplying multiplying the units of our products. For example, if we have the 3 products that cost $15,000, its cost will be 3 multiplied by 15, gives us 45. I think it is so easy, that's why I haven't written it. And let's talk about FIFO, first in, first out. That means we will sell our first product, or we will sell our product that was purchased first. This method is mostly common in stores. That gives us an advantage to reduce our abnormal wastage and also perishable goods. In September, the following transactions took place. We had the opening inventory of 6 units, which cost $4, 10 units $8, purchased goods, sales 8 units, purchased 12 units at $7, and sales 10 units. How much will be our cost of sales? Okay. Actually, in the cost of sales, we had 6 plus 10 gives us 16, less 8 plus 12 gives us 20, and sales of 10. That means we had 10 units in our closing inventory, right? How do we do it? Actually, it is my advice that you will find this 10 inventory from the last purchase. For example, we have the last purchase 12 units, so the cost of the 10 units is all at the $7. Seven is multiplied by 10 gives us $70. Okay. What happens if we had 14 units, right? You may have this kind of question. We take 12, $7, $7, and we look at the previous purchase 10 units plus 2 is another one. 12. Our 12 unit is from this inventory, from this purchase, I mean, and our rest of goods are from this purchase. This is the core concept of first in, first out. 2 is multiplied by 8, which gives us $100. I think this is understandable, easy peasy, right? Okay, now we will continue. We have AVCO method. There are two methods of AVCO. AVCO, first of all, the average is calculated in, it is called periodic, right? How do we find it? We have the formula. Unit price equals opening inventory is multiplied by cost plus total purchase and divided by opening inventory units added by total purchase units. That's it. Here our unit price equals 6 multiplied by 4 plus 10 multiplied by 8 plus 12 multiplied by 7 and divided by 12 plus 10 plus 6. That gives us the cost of 6.71. That's it. And now we will do it. What will we do in this case? We have 6 units of inventory plus 10 units of purchase and less 8 units, which gives us 8 units and also is added by 12 units, 20 units less 10 units. So we had the 10 units in our closing inventory, and this unit is multiplied by our unit price. Unit price is closing inventory units. That's it. 10. $67.1. I think this is also very easy. And we had another method, AVCO continuous method. This is a bit difficult to calculate. First of all, we had opening inventory six units and purchase $8, 10 units. After all purchases, we are needed or we are required to find our average cost. In this case, our average cost will be 24 plus 80 divided by 16, 6.5 $6.5. Yes, this is a rule. You had to find the average cost after total purchase. If we had also purchase here, you will add this purchase also, and after that you will find the average. If it is understandable, we will continue, and we have the sales of how many units? 8 units, and after all sales, we will find the balance. We had the cost 6.5 and balance is 8, gives us total inventory of 6.5 is multiplied by 8 is 52. Okay, that's it. And also we will also calculate the next purchase, $7, 12 units. We will find the average. How will we find the average? We will take the total purchase and also closing inventory is added and divided by total units. Now we had the 20 units. This gives us 84. I am perfectionist. I think that you understand it. 136 is multiplied by 20. This gives us the amount of 6.8. Yes, we had the also average purchase, and we had the sales. How many units? 10 units sales. Balance, we had the cost of our closing inventory 6.8 and 10, which gives us 68. If you see AVCO continuous method, AVCO periodic method gives us 67.1, continuous is 60.8. In the FIFO method, we had the amount that was 70. Yes, because we had 10 units and that gives us 70. If you see it, all of them give us different method, different values. This means all of the companies choose the method depending on what they do, for what are they specialized in. And there is also one thing to remember. Always remember that FIFO gives us higher amount of inventory in the times of rising prices. Why? Because in this case our inventory is valued at our last purchase in higher amount. That's why FIFO gives us higher amount in the times of rising prices or in the times of inflation. This will be asked from you in theory questions about inventory. Okay, we had also the last method. This is LIFO. LIFO is banned by IFRS. Yep. So it is not used in the practice if the statements are prepared under IFRS. Okay, this is our last lesson. This is our not last lesson. This is the end of our lesson. And take care. And I believe that our lesson was really useful for you. If you don't understand something, watch the previous lessons. Goodbye.